I want to tell you about a conversation I have had more times than I can count at this point. Someone finds out I rent, and the look I get is a specific combination of concern and mild pity, like I have just told them I am still using a flip phone or that I have never heard of a Roth IRA. And then comes the line that I have memorized because I have heard it so many times. You know, renting is just throwing money away, right? And I smile because I used to believe that too. I genuinely did. I absorbed that piece of conventional wisdom the same way most of us absorb it, through cultural osmosis, through well-meaning parents and relatives, through the collective assumption that homeownership is the obvious correct financial move for any adult who is serious about building wealth. And then I actually ran the numbers. Not the numbers, the real estate industry presence, which are carefully selected to make buying look as attractive as possible. The complete numbers. Every dollar that leaves a homeowner's pocket every single month, including the ones that never come back, never build equity, never appear on any mortgage statement, and never get mentioned in the conversation about how buying is always smarter than renting. When I ran those numbers on a $500,000 starter home in 2026, what I found genuinely surprised me. And today I want to walk you through every line of that calculation, show you exactly where the conventional wisdom breaks down, and explain why renting and investing the difference is not a consolation prize for people who cannot afford to buy. It is in many markets right now a mathematically superior wealth-building strategy for people who understand what they are actually comparing. I covered the structural housing market freeze in a previous video on this channel, the lock-in effect, the housing shortage, why waiting for a 2008 crash is probably the wrong strategy. If you have not seen that one, I will link it. Today I want to go deeper on the pure financial math of renting versus buying because I think this specific calculation deserves its own full conversation. Subscribe right now if you are new here. Let's build this out together. I want to start by establishing the complete cost of owning a $500,000 home in 2026 because I think most people drastically underestimate this number, and the underestimation is not accidental. The real estate and mortgage industry has a very strong incentive to frame homeownership costs as narrowly as possible. The narrower the cost framing, the more attractive buying looks. My job today is to give you the complete picture. Let's build this out line by line. The mortgage payment. With a 20% down payment of $100,000, you are financing $400,000. At a current rate of approximately 6.5% on a 30-year fixed mortgage, your principal and interest payment is approximately $2,528 per month. That is the number most people lead with when they talk about what a home costs, but we are just getting started. Property taxes. The national average effective property tax rate is approximately 1.1% of assessed value annually. On a $500,000 home, that is $5,500 per year or approximately $458 per month. This number varies significantly by location. Some states like Texas and Illinois run considerably higher, some states run lower, but 1.1% is a reasonable national baseline. This money goes entirely to the government. It builds zero equity, it never stops. As long as you own the home, you owe property taxes every single year for the rest of your ownership. Homeowners insurance. A reasonable estimate for a $500,000 home is approximately $150 to $200 per month, depending on location, age of home, and coverage level. Let's use $175 as our working number. This also builds zero equity and never stops. Private mortgage insurance. If you put down less than 20%, and in 2026 with a $500,000 home and the requirement for $100,000 down, a very large number of buyers are putting down less than 20% because accumulating $100,000 in liquid savings is genuinely difficult. You owe PMI on top of everything else. PMI typically costs between 0.5 and 1.5% of the loan amount annually. On a $400,000 loan at 1%, that is $4,000 per year or $333 per month. This money is essentially a poverty tax for not having been wealthy enough to put 20% down. It builds zero equity. It goes entirely to an insurance company that is protecting the lender, not you, against your potential default. For simplicity, let us assume our buyer managed to put down 20% and skip PMI. Even so, we are now at $2,528 plus $458 plus $175, which totals $3,161 per month before we get to the cost that I think most people most dramatically underestimate. Maintenance and repairs. This is the hidden cost of homeownership that almost never appears in the buying versus renting conversation, and it is the one that tends to blindside new homeowners most aggressively. The standard rule of thumb used by financial planners and real estate professionals is that you should budget approximately 1% of your home's value per year for maintenance and repairs. On a $500,000 home, that is $5,000 per year or approximately $417 per month. Some years you spend less. Some years the roof needs replacing or the HVAC system fails or the water heater dies and you spend significantly more. Over a long ownership period, 1% annually is actually a conservative estimate for many homes. This money is gone, it does not build equity. It does not come back when you sell. It is the cost of keeping a physical asset in functional condition. And unlike rent, which your landlord is responsible for budgeting and absorbing these costs, as a homeowner, every single one of these expenses lands directly on you with no warning, no smoothing, and no option to simply move somewhere with fewer maintenance problems. Adding maintenance brings our monthly cost to approximately $3,578 per month. And I have not yet included HOA fees if applicable, which can run anywhere from $100 to $600 per month in many markets. I have not included the gradual cost of updates and renovations that virtually every homeowner undertakes over a multi-decade ownership period. And I have not included the transaction costs of buying the home in the first place, closing costs, inspection fees, and agent commissions that typically run 2 to 5% of the purchase price on the buy side alone. The hook for this video puts the monthly ownership cost at $4,367. Let me show you where that comes from with slightly different assumptions. If the buyer put down 10% instead of 20%, the PMI kicks in at approximately $333 per month, and the mortgage payment increases to approximately $2,845 per month on a $450,000 loan. Add property taxes at $458, insurance at $175, PMI at $333, and maintenance at $417, and you land at $4,228 per month. Add any HOA at all, and you are at $4,367 or beyond very quickly. That is the honest monthly cost of owning a $500,000 home in 2026 for a buyer who did not have $100,000 for a down payment, which describes the majority of first-time buyers in this market. Now here is where I want to really dig into the throwing money away argument, because I think it deserves a direct and honest response rather than a dismissal. The throwing money away argument rests on a specific assumption. It assumes that the only alternative to building equity through a mortgage is having nothing to show for your housing costs. Paying rent equals lost money. Paying a mortgage equals building an asset. Therefore, mortgage always beats rent. But this framing has a fundamental flaw that becomes obvious the moment you ask one question. How much of my monthly housing cost as a homeowner is actually building equity? Let me answer that question with the real numbers, because I think the answer surprises most people who have not looked at it carefully. In the early years of a 30-year mortgage, the overwhelming majority of each payment goes to interest rather than principal. On a $400,000 mortgage at 6.5%, your first monthly payment of $2,528 breaks down approximately as follows. Roughly $2,167 goes to interest. Roughly $361 goes to principal reduction. That means in month 1, approximately 85% of your mortgage payment goes to interest, which does not build equity. Only 15% actually reduces what you owe on the home. This ratio gradually shifts over the life of the loan. By year 15, you are paying roughly half and half. By the final years of the loan, you are paying mostly principal. But in the early years, which is exactly when the buying versus renting debate is most relevant for most people, the equity building portion of your mortgage payment is surprisingly small. Add property taxes, insurance, PMI, and maintenance to this picture, and the monthly cost of homeownership that is genuinely unrecoverable, that never comes back, that is truly gone, is considerably larger than most people realize. In the scenario above it is easily $2,500 to $3,000 per month of truly unrecoverable spending. Meanwhile, a renter in the same market might be paying $2,200 to $2,500 per month for a comparable home, every dollar of which is, according to the conventional wisdom, being thrown away. I want to challenge that framing directly. Rent is the cost of housing. Property taxes, insurance, PMI, interest, and maintenance are also the cost of housing. The difference is not that one builds wealth and one does not. The difference is which category of housing cost you're paying and what you do with the money you are not spending. This is where the invest the difference piece becomes the central argument, and I want to build it out in detail because the math is genuinely compelling. In the scenario I described, buying that $500,000 home with 10% down costs the buyer approximately $4,228 to $4,367 per month all in. A renter in the same market paying $2,200 to $2,400 per month for comparable housing has a monthly difference of approximately $1,800 to $2,000 compared to the buyer's total housing cost. What happens to that $1,800 per month difference if the renter invests it consistently in a low-cost S&P 500 index fund? $1,800 per month, invested at a historical average return of 8% per year, grows to approximately $107,000 after 5 years. After 10 years, it grows to approximately $264,000. After 15 years, it grows to approximately $498,000. After 20 years, the portfolio is worth approximately $854,000. Now I want to be fair here because the homeowner is also building something during this period. Let me put the homeowner's equity position alongside the renter's investment position for an honest comparison. The homeowner, after 20 years, has paid down a meaningful portion of their mortgage principal. On a $450,000 loan at 6.5% over 20 years, they have reduced the balance to approximately $310,000. If the home has appreciated at a historically conservative 3% per year from $500,000, it is now worth approximately $903,000. Equity is approximately $593,000. The renter who invested the difference has approximately $854,000 in a liquid, diversified investment portfolio. These numbers are closer than the conventional wisdom suggests they should be, and the renter's number has several significant advantages that the homeowner's number does not. The renter's $854,000 is fully liquid. It can be accessed, rebalanced, or deployed without a 6 to 8% transaction cost. The homeowner's $593,000 in equity requires a sale to access, at which point agent commissions, closing costs, and capital gains considerations will reduce the actual amount they walk away with by a meaningful percentage. The renter has had no maintenance surprises, no property tax reassessments, no HOA special assessments, no roof replacement emergencies in the middle of a tight financial month. Their housing cost has been predictable within the bounds of normal rental market changes. The renter has had full geographic mobility throughout this period. Career opportunities in different cities, life changes that might make a different housing situation desirable, all of these were available to the renter at essentially zero transaction cost compared to the enormous friction of selling a home. And the renter has not had $100,000 of their capital tied up as a down payment for 20 years. That $100,000 invested at 8% for 20 years becomes approximately $467,000 on its own. The down payment opportunity cost is the number most people forget to include in the comparison. I want to be honest about the counterarguments because I think the honest version of this analysis acknowledges them rather than pretending they do not exist. The homeowner's position does benefit from leverage in a way the renter's position does not. When the $500,000 home appreciates to $903,000, that $403,000 in appreciation happened on top of a $50,000 down payment initially, meaning the return on the initial cash invested is very high. Leverage amplifies gains. But leverage also amplifies losses and concentration risk. The homeowner's wealth is almost entirely concentrated in a single illiquid asset in a single geographic market. The renter's wealth is diversified across hundreds of companies in multiple sectors and geographies. From a portfolio construction standpoint, the renter's wealth is structurally sounder even if the total numbers are comparable. Homeownership also provides the stability and control of your own space that renting genuinely cannot replicate in most markets. You can renovate. You can paint any color you want. Your landlord cannot decide not to renew your lease. These are real quality of life factors that have real value and they belong in an honest comparison. My argument is not that renting is always better than buying. My argument is that renting while investing the difference is a mathematically legitimate, genuinely wealth-building strategy that the conventional throwing money away framing completely misrepresents. And in a market where the all-in cost of buying a median-priced home is $4,000 or more per month for a median-income household, that misrepresentation is actively steering people toward financial decisions that make them house poor and investment poor simultaneously. House poor is the term for owning a home that has consumed so much of your monthly cash flow and your available capital that you have nothing left to invest, nothing left for opportunities, nothing left for emergencies without going into debt. And I see it constantly. People who technically own their home are proud of their homeownership and are simultaneously carrying credit card debt, have no investment accounts, and could not absorb a $3,000 emergency without genuine financial crisis. That is not wealth. That is an illiquid asset wrapped in financial fragility. And it is what happens when someone buys a home because culture told them it was the right move without running the actual numbers for their actual situation. Let me give you the 3 questions I think every person should answer honestly before making a buying versus renting decision in 2026. Question 1. What is the complete monthly cost of the specific home I am considering, including mortgage principal and interest, property taxes, insurance, PMI if applicable, and a realistic maintenance reserve, not the mortgage payment alone, the complete number? And what percentage of my gross monthly income does that complete number represent? If it is above 30%, I am in house poor territory before I even close. Question 2. What would I actually do with the difference if I continued renting? This question matters enormously because the rent and invest strategy only outperforms buying if the investing actually happens. Renting and spending the difference on lifestyle inflation is not a wealth-building strategy. It is just a different way to have nothing to show for your housing years. The investment has to happen consistently and automatically, or the math I showed you evaporates. Question 3. What is my realistic time horizon in this specific location? The transaction costs of buying and selling a home are so significant that buying only makes financial sense if you are confident you will stay for at least 7 years and ideally longer. If there is meaningful uncertainty about your location in the next 5 years, the financial argument for renting strengthens dramatically regardless of what the monthly payment comparison looks like. I am not telling you not to buy a home. I own a home myself, and there are genuine quality of life and stability reasons to buy that matter beyond the pure financial math. What I am telling you is that the cultural conversation around renting versus buying is deeply dishonest about the complete costs of each option, and that the person who rents intentionally, invests the difference consistently, and understands exactly what they are doing is not throwing money away. They are building wealth, quietly, flexibly, on their own terms, without a $4,000 monthly obligation tying them to a specific house in a specific city with a maintenance emergency always waiting somewhere in the walls. The math supports that choice. Now you have seen the math clearly for the first time, use it. Hit subscribe if you want to keep building this kind of honest financial picture with me every week. Share this with someone in your life who is feeling pressured to buy in this market before they have run the real numbers. That conversation might genuinely change their financial trajectory. This is Dave. I will see you in the next one.